Imagine you're earning your first paycheck. You've worked hard. Now you finally have some money. But then comes the biggest question. What should you do with it? Family member says, buy gold. Friend says, buy Bitcoin. Uncle says, real estate. Coworker says, buy stocks. Truth is, most beginners don't fail because investing is difficult. They fail because no one teaches them where to begin. This video isn't about getting rich quickly. It's about building wealth slowly and intelligently. Because successful investing is a marathon, not a sprint. Before investing even $1, ask yourself one simple question. Why am I investing? Different goals require different investments. Buying a house, children's education, retirement, emergency savings, travel. Each goal has its own timeline. Investing without a goal is just gambling. Goals force the discipline. Without a target, you are only throwing money at the dark and hoping the noise sounds like winning. The second question is, when will you need this money? If you need money within 3 years, taking too much risk could be dangerous. When time is short, you cannot afford to lose your money. If your goal is 20 or 30 years away, you can usually tolerate more market ups and downs. Time is one of the greatest advantages an investor can have. Age also matters. Generally speaking, younger investors often have more time to recover from market declines. As retirement gets closer, many people gradually become more conservative. The goal shifts from growing wealth to protecting it. There is no perfect age, only the right investment strategy for your stage of life. Success comes down to your life stage and how you invest. Before investing, build an emergency fund. Unexpected expenses happen. Job loss, medical bills, car repairs. Without emergency savings, you may be forced to sell investments at the worst possible time. A strong financial foundation comes before investing because it protects you from debt, unexpected bills, and market crashes. Now let's understand the major investment options, which include stocks, bonds, and real estate. These choices help you grow your money and build wealth over time. Savings accounts keep your money safe with low risk, give you easy access whenever you need it, and work best for short-term goals. They protect your cash. Guaranteed investment certificates, GICs, are safe, fixed-income products that offer predictable returns while locking your money away for a set time. Government and corporate bonds are fixed-income loans you give to issuers in exchange for regular interest payments, offering lower volatility than stocks while carrying unique market and credit risks. When you buy a share of stock, you own a real piece of a living business. Your fortunes rise and fall with the sweat and success of the people running it. Stock prices move every day, sometimes up, sometimes down. But over long periods, many businesses have created significant wealth. Equity mutual funds pool money from many people to buy a mix of stocks managed by financial experts who grow and protect your investments. Exchange-traded funds, ETFs, are flexible baskets of securities that trade just like individual stocks. They offer instant diversification, lower costs, and easy buying and selling. Real estate. Property can generate rental income and may appreciate over time, but it also requires significant capital and ongoing responsibilities. Gold. Often viewed as a store of value, it can help diversify a portfolio, though it does not produce income like dividends or interest. Risk and return usually go together. Higher potential returns often come with greater uncertainty. Safe paths yield small gains. Every investment carries some level of risk. The key is understanding the risks before investing. Knowing the risks before you buy protects your money. Never invest in something just because a friend or someone tells you to do. Take the time to understand it first and then decide. Diversification is one of the most important concepts in investing. It means spreading your money across different investments. It works because when one asset goes down, another may go up, which lowers the risk.
Stay safe.
Diversification doesn't eliminate risk, but it can help reduce the impact of any single investment performing poorly. The ultimate trap for any beginner is chasing the illusion of overnight wealth. When you rush the process, you do not build a foundation. You build a house of cards. Successful investing is usually boring. True wealth grows not from sudden leaps, but from the unyielding power of time, calm patience, and discipline. Compounding works best when given time. The earlier you begin, the longer your money has the opportunity to grow. Before making any investment, always ask yourself, do I understand how this works? What are the risks? How long am I planning to invest? If you cannot explain an investment in simple words to yourself or someone else, then you probably shouldn't invest in it yet. Before you risk a single dollar of your hard-earned money, you have to risk your time. Learning comes before investing. Always. Let's recap. Know your goals. Understand your time horizon. Build an emergency fund. Learn the different asset classes. Diversify. Stay patient. Keep learning. Investing isn't about finding the next big winner. It's about making thoughtful decisions consistently over many years. If you found this video helpful, consider subscribing for more educational videos on investing, personal finance, and long-term wealth building.